Hello, good morning, everyone. Joseph Lackland here. This is the pre-market morning report for Tuesday, April 28th, 2026. Welcome back to the channel. Thank you for stopping by. When I turned on my screen this morning, I noticed that the crude oil was trading above $100. And then I looked at the chart and I saw that there was not any great major news candle or some sort of event or whatever it was. It was pretty much a very slow and methodical rise to the high here, just shy of 102, starting at around 96.50, which is about where we closed yesterday. So the crude oil has slowly but surely rallied 500 ticks here overnight. I looked at the news headlines and I did not see any major developments, no attacks, no, sinking of ships or, anything dramatic. And it's the usual sort of news headlines that you would read on a normal day. So OpenAI misses revenue, uranium stock backed by a 1.14 billion track record. Can they do it again? The dollar's funeral keeps getting rescheduled. Financial news, things of that nature. This one, first loaded LNG tanker clears Hormuz. First crude supertanker attempts exit. This looks, slightly positive, if anything. So this would normally put pressure on oil prices. If ships are getting through, the war is going to resolve soon. Things are not getting worse; they're getting better. And then this story says oil is rising quietly, too quietly. This is a pretty good one. It's a premium article. I don't have the paid version of Zero Hedge right now, but we can't read that. But the headline, basically says it all. It's doing exactly what this is doing overnight. Oil's rising quietly. It's up 500 ticks. You wake up, it's trading north of $100. This is the first time that we've traded above $100 in a couple of weeks since we had the big cascading sell-off from 114. Now, I outlined over the last couple of sessions that the gasoline is very strong. So if we look at the gasoline chart, this is a trading range up here at the high from 320, let's just call it 327 down to 280, right? So we've basically been in this trading range since the middle of March. And we're now taking and capturing territory north of this trading range. 342 is where we're at right now. The low is 335. The daily volatility is 4% right here. So the gasoline is not moving as much as it was when the war started. We had 10% moves here in the gasoline, but it is still moving about 4 or 5%, and it is now in territory that it has not seen since the Ukraine war. So I believe that the high around Ukraine was near the 5 handle. So we have another $1.50 to go in the gasoline, and each handle is 10,000 ticks at $4.20 a tick. So there might be another 40, 50, $60,000 per contract move here in the gasoline. And that would put prices at the pump significantly higher than they are right now. So the energy market is now pricing in the reality that no matter what happens from this point, that we are going to have elevated energy prices. I'm going to repeat that again. No matter what happens from this point, we are going to have elevated energy prices. And the reason for that is because we have a deficit that is happening every day. So every day we have anywhere from 8 to about 13 million barrels per day of oil that's not making it to the world for consumption. The world continues to consume the regular amount of oil. And it says here, I gathered some metrics, and I have checked most of these. I have seen some other YouTubers that are pretty good, that are pretty reputable, that are talking about the same thing. So I didn't come up with this. I saw this out there over the last week or two, and I'm just going to sum it up for you guys right here. So basically, what's going on is that the baseline supply flow, normal flow through the Strait of Hormuz, is about 20 to 22 million barrels per day. It represents 20% of global supply. Current disruption estimates from the war and the blockades, production supply outages estimated range 7.5 to 9.1. Peak disruption range observed 8 to 12. This reflects actual production shut-ins and export interruptions. Flow restrictions through Strait, estimated constrained flow 10 to 11 million barrels per day, includes partial transit disruption, shipping risk, and reduced throughput. Worst case scenario, prolonged constraint. This war just absolutely gets worse and worse and worse over the next couple of months and doesn't get better. Estimated loss 13 million to 14 million barrels per day. Mitigation factors. The market is partially offsetting the disruption via pipeline rerouting, strategic petroleum reserve releases. There's a limited amount of petroleum reserves, so they can't do that forever. Alternate export terminals, Red Sea, United Arab Emirates, bypass routes, spare production capacity, Saudi Arabia, UAE. Net effective supply deficit after accounting for mitigation, estimated real market shortfall 8 to 10. So of the 20 that usually flows through there, we're at about half capacity at the moment. Says here, market interpretation, not all disruptive barrels immediately translate into shortage due to buffering mechanisms. Inventories are actively being drawn down. Physical market tightness is increasing, especially in diesel, jet fuel. Observed effects, elevated crude prices, tightening forward curves, increased volatility across energy markets. Well, we're getting a little increase in volatility here in the energy market. Slowly but surely, the gasoline is north of 330. And the crude is now at 100. The last time the crude got near 100, it took a few days for it to hit 110. And it went from 96 to 110 in one day. So it could absolutely do that again if it really wants to. Summary. Gross disruption 8 to 12, net effective deficit 8 to 10, extreme scenario 13 to 14. It says the bottom line, the current environment reflects a structural supply deficit of approximately 8 to 10 million barrels per day, with underlying disruptions closer to 10 to 12. I had Claude draw us a little chart over the next couple of months, and we can see here the estimates where we have the gross disruption, 8 to 12. We have a couple of bands here. We have the net effective deficit. It says gross disruption high, gross disruption low. Net deficit is the blue in the middle. Net deficit low is 8. Extreme scenario 12, the green dashed line up here. It says this chart runs from today, April 28th, through the end of June, plotting 3 scenarios across the 9-week window. So we have different degrees of interruptions here and deficits. A few modeling notes on the shape. Both bands trend slightly upward into late May on the assumption that inventory buffers and pipeline rerouting capacity get increasingly strained over time than plateau. So this is getting worse. It's going to continue to get worse no matter what until it hits an equilibrium point, and then maybe it will start to improve. However, the 8 to 12 million barrels per day shortfall is cumulative, that this is a cumulative effect. So this is about 450 million barrels per month. And in a few months, this is billions of barrels that are not in the supplies, and the world continues to consume energy at the normal rate. So there's something wrong with this equation here, that this cannot continue for too much longer. Then I said generate price scenario ranges for CL based on the Hormuz disruption analysis. Give me bull base and bear cases with price targets. It originally gave me 105 to 130 in WTI, and then 85 to 105 with the partial constraints, and then resolution at 62 to 85. And I said, no, that's not right. And the reason I said, no, that's not right, is that spot prices hit almost 150 the other day, and Brent now is above 110. So Brent is more expensive than WTI, and spot prices are even more expensive than that. It reformulated the response, and it now thinks that the realistic escalation continues price range is 120 to 155. The base, the grinding stalemate that's in place right now, we're in peace talks, we're not in peace talks, there's negotiations, the negotiations fail. We've seen this now for a couple of weeks. This story is not changing. The military buildup continues. The deficits continue to pile up. The disruption in the strait is consistent. The strait is, functionally not open. A few ships are getting through, but 90% of the traffic is not going through there. So the stalemate is 95 to 120. Here we have some price projections over the next couple of months. These are rough estimates. These are not, hard numbers to actually trade off of. The market's going to do, this as we move. The market goes up, the market goes down, the market goes up, the market goes down. These are more like envelopes rather than hard numbers that we can use to actually trade off. The key context, WTI is up about 55% year over year, and the conflict is now in its ninth week, with the IEA describing it as the largest energy supply shock on record. Absolutely. The reality is starting to set in that this is the worst energy crisis that we have ever gone through. WTI hit 119.54 as its year-to-date high earlier this month, and both benchmarks have nearly doubled since January when WTI was below 58. So oil's basically doubled, and we still have a disruption, and the Strait is still closed. So the $99 spot today is actually a pullback from the April peak. The market is partially priced in ceasefire hold scenario via Pakistan mediation, which is why we're not at 120 right now. Well, we're getting there. The real scenario structure at current prices. The base case 95 to 120 is where you live right now. The $99 spot is sitting right in the middle of this band. Every Iran proposal headline pulls it towards 95. Every breakdown in talks pushes it back toward 115, 119. So the news gets worse. Oil starts going back toward the high. Then they float out the negotiations and peace talk dialogue, and the market comes back in. This is the typical behavior pattern over the last couple of weeks. And it's consistent now. It's every day. So it's regular. We're used to this now. We see the same kinds of news headlines with the same kind of behavior now. Also with the same rhetoric that things are going to be resolved in a couple of weeks. Well, that was a couple of weeks ago, and it's a couple of weeks later. The bull case 120-155 is grounded in JP Morgan's warning that Brent could overshoot 150 if Hormuz stays closed into mid-May. That's only a couple more weeks. Brent's already north of 110. Another $20, $30 is not outside the realm of possibility at all. With Goldman flagging 135 as an extreme peak scenario. So we have the Goldman raises oil target with 120 on radar. This is one of these headlines right here. So let's just read this real quick. Just 1 week after Bank of America stated that oil futures were way too cheap, Goldman and Deutsche Bank seemingly concur and put their own price upgrades for oil. Well, they had to have known this already. They have teams of PhDs and analysts in their office that are all very, very smart, that are working together to try and figure this out. I highly doubt that they figured this out just now. Markets are facing a sustained supply shock driven by Hormuz disruptions, enforcement actions, and delayed recovery timelines. This is what I'm talking about, the sustained supply shock due to the deficits each day that keep piling up. Record inventory draws are tightening conditions despite softer demand, while limited supply response keeps the market undersupplied. Of course, the strait remains closed. The market is undersupplied. Price risks are skewed higher with forecasts rising and upside scenarios pointing to significantly elevated oil prices. Sustained, significantly elevated oil prices. That is what we're in for here. They go on to make a couple of graphs and explain why the supply disruption becomes structural. I'm not going to read the whole article, but you can definitely check this out. This is a decent article. I've gone through it. It gives a lot of important evidence and provides some perspective to support the case here. So I will let you guys check that out. It's on Zero Hedge. Goldman raises oil target with $120 on radar. There's no real other news headlines in here, so we have not a whole lot of headlines, and the market is now actually trading more like it normally would on its own and coming up with the price that seems to be the balance of supply and demand in a more accurate fashion than it has before. Now, the stock market obviously doesn't like this at all, and we're starting to come in a little bit on the S&P. We're still not even down that much. We made a new high overnight, 72.20. We're off about 60 or 70 handles. We are trading below the low of the previous session. It's nothing. It's nothing real serious yet. Volatility is still low. Nasdaq is similar picture. It is down about 400-500 handles from the high, but for Nasdaq, that's not really that much. Again, the Nasdaq usually moves more on a percentage basis than the S&P anyway. So we are starting to correct. We are by no means in a serious correction, but that could all change relatively quickly. We did go through the previous day's low. It is the exact opposite pattern of the crude. It's a slow, steady drift down that starts to accelerate here before cash opens. So we went through the opening range of yesterday. We went through the previous day's low, the first support. We went through the second support. We're now on the third support level. We have a couple of extreme support levels down here, but we're already through the S2. That's the big one for me. If the market's not holding the S2, then it is weak. It can go through the low and trade the S1 and come back. It's not a big deal. Once it punctures the S2, this is a structural break. We can see that the volatility is going up as well. So not only do we have a structural break in the support pattern, but we now have volatility elevated here. These are the ingredients for an event type of day where the market drops a considerable amount more than anybody is expecting. The ES is a similar story. It's the drift down from the overnight high early made near Asia. We went through the opening range of yesterday, through the S1, through the low that was made first. Now the ES is hanging on to the S2. The ES hasn't given up the S2 yet. We do have these other support levels lower that it may hit, but we're going to basically open the US session on the low here, and then we will figure out what is going to happen from here. So that is the picture for the indexes. If we look at gold, gold is following the trend lower. Gold does behave like a risk asset lately, so the gold has been drifting. We're now at the lower deviation. We may have some metal buyers here that provide support to the market, but the market is definitely vulnerable and it is being attacked right now. So the gold volatility is high. I've been mentioning that gold volatility has been pretty low and muted for a couple of weeks now. We are getting that elevation in gold volatility. So what is my trading plan for today? My trading plan for today is to focus on oil. I will let the machine trade the oil. There's going to be some volatility in here, so I may reduce size slightly. And we will see what happens with the stock index futures. There will definitely be some buyers in here that are short or more longer term people that have been waiting for a pullback to buy, that there has not been a pullback for weeks. So if there is a pullback here, there will be initially some buyers that provide support to the market. Whether or not that holds, we shall see as the day progresses. If I'm able to get a couple of script demonstration videos together, I will put those out. I was not able to get them together yesterday. The market action was just very choppy. Results were mixed and slightly positive in NASDAQ and gold and negative in crude. So I'm not just cherry picking the results. I couldn't find some good action to where I could demonstrate what the script was doing. Trades were taking much too long to resolve. I would make a trade and then I would wait about 20, 30, 40 minutes for the trade to resolve. So there was not a whole lot of good flow there for a video. The video would have been rather boring, trying to make it exciting. So we have about 40 minutes until US Open. I'm going to get this video uploaded and out there, make a nice cover for it so that you guys can check it out. And hopefully I will see you guys later for the demonstrations. But if not, good luck out there today. Keep your eyes on the prize. Watch the oil, watch the gasoline, keep an eye on these stock indexes, and beware the news headlines, because this is exactly the type of environment where news headlines come out that dramatically change the landscape as the market rushes to price in the news all at once. We can thank our beloved leaders and their social media accounts for providing us with this information basically instantaneously at the drop of a hat. So that will conclude today's episode. Thank you for joining me. I will see you guys on the next one.